You show up Monday morning, you badge in, you pour coffee from the same machine that has been there since before you started. Your manager gives you a project update. You nod, you take notes. You sit in the same chair you have sat in for 3 years. And somewhere inside a filing cabinet, or more precisely inside a registered document with a state agency, your name is attached to the majority of the equity in the company you just walked into. Nobody in that room knows. That is not a crime. It is not a trick. It is how private company ownership has always worked, and almost nobody who punches a clock inside one of these businesses thinks about it until the day they could be the one doing it. Here's the first thing to understand. A $4.2 million company can change hands on a Tuesday with no press release, no stock ticker movement, no 8K filing, no headline anywhere. Private companies do not report to the public. There is no cap table posted on a website. There is no exchange where the transaction clears. A private business acquisition closes at a title company or an attorney's office with a stack of documents, a wire transfer, and 2 signatures. That is it. The company opens Wednesday morning and makes sandwiches or processes invoices or moves freight exactly the way it did the week before. The employees do not know. The customers do not know. The vendors do not know. The only people who know are the people who need to, and you get to define who that is. That is not secrecy as deception. That is just how private markets operate. It is the same opacity that lets the person who owns the dry cleaner on your block avoid explaining their balance sheet to their staff. Private is the default. Public is the exception. Now let's be precise about what owning it actually means, because the word ownership splits in 2 directions and they are not the same thing. There are economic rights and there are voting rights. Economic rights tell you how much of the profit you receive, how much of the sale proceeds come to you when the business eventually sells, and how the distributions flow. Voting rights tell you who makes decisions, who approves the operating budget, who can remove the manager, who signs off on a major asset sale. You can structure a cap table where one party holds the majority of economic rights and a different party holds voting control. These are separable. When this video says majority, it means voting control plus majority economic interest, not a minority position dressed up to sound like more. A cap table is simply a table. It lists every owner, the class of their ownership units or shares, and the percentage they represent. On a clean acquisition through a holding structure, your name, or more precisely the name of your holding entity, occupies the majority row. Everything flows from that row. Which brings you to the 2 layers that create the invisibility. Layer 1 is the holding LLC. You do not buy the operating company directly. You form a separate limited liability company, the holding entity, and that entity acquires the shares or membership units of the operating company. Your name appears on the holding LLC's formation documents filed with the state. But the operating company's public-facing records, the ones a vendor might look up, the ones a customer might encounter, those still show the operating company as the entity they have always dealt with. The holding LLC sits 1 level above. It is visible in the right places. It is simply not in anyone's face. Layer 2 is that the operating company stays outwardly unchanged. Same name, same bank accounts, same employees, same phone number, same customer contracts. The business does not rebrand on day 1. It does not announce new ownership in a press release. It continues. The transition structurally is invisible to the market it operates in. That is intentional. It protects customer relationships, it protects vendor terms, it protects employee stability. It is also just good business. Now here is the line you do not cross, and this is not a footnote, it is the entire foundation. None of this is hidden from the people who require disclosure. Your lender sees the full structure on day 1. If you are using an SBA 7 loan, the bank has your personal financial statement, your tax returns, your holding LLC's operating agreement, and your name on a personal guarantee. There is nothing opaque to them. They own your signature. Your attorney drafts the documents and holds the closing. Your accountant or CPA sees every entity, every transfer, every distribution. The IRS knows who owns what because your holding LLC files, your operating company files, and beneficial ownership is reported to FinCEN under the Corporate Transparency Act's BOI requirements. You file that report. You file it accurately. You file it on time. You are not using a nominee. You are not listing someone else's name to hide your ownership. You are not telling the bank a structure that differs from the legal reality. Clean documentation and clean governance are not optional features. They are the structure. The moment you introduce deception to the lender or to any required filing, you are not doing a quiet acquisition. You are doing fraud. Those are not the same thing and they do not belong in the same sentence. What you can keep private is social. You do not owe your coworkers an announcement. You do not owe your neighbors an explanation. You do not need a LinkedIn post. Private company ownership is private by design, and there is nothing unusual about a business continuing to operate while a new majority holder manages it from a holding entity 1 layer above. You badge in Monday morning. The coffee machine runs. The meeting starts, and the cap table already has your name on it. That is what this actually looks like. The business is worth $4.2 million. That number did not come from nowhere. It came from a multiple. Here is how the math works before any lender enters the room. Seller's discretionary earnings, SDE, is the number that drives small business valuation. It is not revenue, it is not EBITDA in the corporate sense. It is the total economic benefit flowing to a single owner-operator. Net profit plus the owner's salary plus any personal expenses run through the business plus non-cash charges like depreciation. It is the answer to the question, what does this business actually put in the owner's pocket in a given year? For a $4.2 million acquisition at a 3.5 times multiple, the implied SDE is approximately $1.2 million. That is the number your lender will reconstruct from 3 years of tax returns and financial statements. That reconstruction is called a quality of earnings review, and the bank does not skip it. At 3 times to 4 times SDE, you are in the standard range for a profitable small business with some customer concentration risk, some owner dependence, and stable but not explosive growth. A business with recurring revenue, long-term contracts, and documented systems might push toward 4.5 times or 5 times. A business where the owner is the product and half the customers call his cell phone trades closer to 2.5 times. The multiple is an opinion compressed into a number, and the lender treats it as a ceiling, not a floor. Now the capital stack. Purchase price, $4.2 million. The SBA 7 program allows the lender to finance up to 90% of the acquisition. The bank puts in $3.78 million as senior debt. Your required equity injection is 10%, which is $420,000. That number is real and it does not disappear. But the 10% equity requirement has a mechanism built into it that most people outside of deal-making do not. No exists. A seller note on full standby can, under SBA guidelines when the lender permits it, count toward the equity injection. Here's what that means in practice. The seller agrees to carry a note, typically 10 to 15% of the purchase price as part of the deal consideration. If structured on full standby, that note pays zero principal and zero interest during the entire term of the SBA loan. The seller receives nothing on that note until the SBA debt is retired. In exchange for accepting those terms, the lender may count some or all of that note as equity rather than debt, which reduces the cash you need to bring to the closing table. A $210,000 seller note on full standby against a $420,000 injection requirement means you arrive with $210,000 in cash rather than $420,000. The seller still gets paid. The timeline shifts. The lender's position is protected. That is the mechanism. It requires lender approval. Not every bank allows it. You ask the question directly and early. The SBA 7 loan itself carries a 25-year amortization for acquisitions involving real estate and typically 10 years for business-only acquisitions. Most small business purchases are the latter. Your $3.78 million at current SBA rates on a 10-year term produces a monthly debt service payment in the range of $42,000 to $46,000 depending on the rate, which floats at prime plus a spread. You model this at the higher end. The SBA also charges a guarantee fee, currently structured on a sliding scale based on loan size, which on a $3.78 million loan runs into the tens of thousands of dollars. You roll it into the loan. You do not absorb it out of pocket. You model it into the total borrowed amount. The gate the lender actually cares about is the debt service coverage ratio, DSCR. The SBA requires a minimum of 1.25, meaning the business generates 1.25 in cash flow for every 1.0 of annual debt service. On $3.78 million finance over 10 years, annual debt service is approximately $500,000 to $550,000. The business at 1.25 times DSCR needs to produce $625,000 to $687,500 in post-owner cash flow to cover service. A $1.2 million SDE business, after adjusting for a market rate management salary for you as the incoming operator, still covers that threshold with room. The lender will stress test that room. They will run it at a 10% revenue decline. They will ask what happens if the top customer leaves. They will want answers, not reassurances. Your personal guarantee is unconditional and full. It covers the entire loan balance. You sign it. Your assets, your income, your liquidity are all on the hook if the business fails to service the debt. This is not a technicality. If the company stops generating cash flow, the bank does not absorb the loss. You do. The personal guarantee is the price of the leverage, and it is not negotiable with an SBA-backed instrument. A mid-level employee can still qualify. The lender is not underwriting your title. They are underwriting your credit score, your liquidity post-close, your industry experience, and the narrative of why you are the right operator. That narrative matters. A credit score above 700, demonstrable experience inside this industry or an adjacent one, some version of documented liquidity, and a coherent explanation of how you will run this business after the seller exits. That is the package. The seller transition period, typically 90 days, written into the purchase agreement, exists precisely to support that narrative. You are not an unknown stepping blindly into an operation. You are someone who knows where the file server is. The closing itself happens at the asset or entity level. Most small business acquisitions close as asset deals where you acquire the accounts receivable, the equipment, the customer contracts, the goodwill, but not the legal entity and not its historical liabilities. The operating name stays. The phone number stays. The employees show up Thursday and see the same ceiling. That is the design. Continuity as a feature, not a coincidence. You do not buy the business in your own name. That is the first structural decision, and it is made before the purchase agreement is signed. You form a holding LLC. It is a single-purpose entity created specifically to acquire and hold ownership of the operating company. The holding LLC is the buyer on the closing documents. The holding LLC is the borrower on the SBA note, with you as the personal guarantor. The holding LLC owns the membership interests or the acquired assets of the operating company. You own the holding LLC. That chain is the structure. It is not complicated. It is also not accidental. The reason is not concealment. The reason is insulation and clarity. If the operating company carries any future liability, the holding entity creates a separation that a direct personal acquisition would not. If you eventually bring in a co-investor or a silent partner, the holding LLC is where that conversation happens, at the ownership level, not inside the operating company. The structure is standard. Business attorneys form these arrangements every week. The SBA lends into them routinely. Now the cap table. For an LLC, there is no stock. There are membership interests expressed as percentages or units. The cap table is the table of who owns what. At close, if you are the sole equity investor, you own 100% of the holding LLC and therefore 100% of the economic interest in the operating company underneath it. That percentage is what the seller note and the SBA debt are stacked against. The lender holds a lien on the assets. They do not hold equity. They are not on the cap table. They have a claim senior to yours in the event of default, but they do not own any portion of the business while you are current on payments. Majority ownership in a private LLC does not mean you have more votes than someone else. It means you control the entity. If you own 100%, you control it absolutely. If you own 51% and bring in a co-investor at 49%, you are still majority. What majority actually means in practice is determined not by the percentage itself, but by the operating agreement. That is where control lives. The operating agreement is the governing document of the LLC. It specifies who manages the entity, what decisions require a vote, what voting thresholds trigger action, and what protective provisions limit the manager's unilateral authority. In a manager-managed LLC, the manager runs day-to-day operations and makes ordinary business decisions without calling a vote. If you are the sole member and the manager, you operate the business without any governance friction at all. If you have outside investors or a minority co-investor, the operating agreement becomes the document that defines every meaningful boundary. What can you do without a vote? Hire and fire employees. Sign contracts below a dollar threshold. Distribute earnings on a schedule. What requires unanimous consent or a supermajority? Selling the company. Taking on new debt above a threshold. Admitting new members. Amending the agreement itself. These thresholds are negotiated and written. They do not exist in the default rules of your state statute. You and your attorney write them. If you write them poorly, a minority investor can create friction at the moments you can least afford it. If you write them well, you retain operational control regardless of what any minority holder wants on a given Tuesday. Protected provisions run in both directions. You may grant a minority investor the right to block a sale below a certain price, or to require pro rata participation in any new equity round. Those are their protections. Your protection is that ordinary business decisions remain yours. The manager-managed structure preserves that. You do not need permission to run the company. You need permission, or at least a vote, to fundamentally change it. Now, why does none of this appear anywhere a casual observer would look? Because the company is private. There is no public shareholder registry for a private LLC in any U.S. state. The Secretary of State filing for your holding LLC lists the registered agent and the principal address. It may or may not list member names, depending on the state. Most states do not require member disclosure in the public articles of organization. The operating agreement, the cap table, the acquisition documents, the SBA loan file, none of those are public records. The business continues to operate under its existing name. The name of the holding LLC may never appear in any customer-facing communication. This does not mean your ownership is hidden from the government. It means it is not published for general inspection. Under the Corporate Transparency Act and FinCEN's Beneficial Ownership Information Reporting requirements, you file a BOI report that accurately discloses your identity as the beneficial owner of the holding LLC. That report goes to FinCEN. It is not searchable by the public. It is not accessible to competitors, co-workers, or the general public. It exists for law enforcement and regulatory access. You file it correctly, completely, and on time. It is a compliance step, not an exposure event. The filing is accurate. The information is real. The filing is simply not a press release. What this means in practice is that your social invisibility for the next 3 years is not a legal fiction. It is a function of how private company ownership actually works. Your title at the operating company can remain whatever makes operational sense. Many buyers retain a general manager title or simply run the company without a title change visible to employees. Your communications with employees look the same as they did before the transaction. The seller's transition period is built into the purchase agreement. You are present in the building. You are managing the operation. Nothing about the daily texture of work announces a change in who owns the equity above the company on an org chart no employee has ever seen. The people who know are bounded and specific. The SBA lender, the closing attorney, the seller, your CPA, possibly a financial advisor if you used one. That list does not expand by accident. It expands only when you choose to expand it, and you choose deliberately. You do not lie. You do not tell employees you don't own the company. You simply do not announce it. Private ownership has never required public announcement. The business runs. Payroll clears. Nobody asks because nobody has a reason to ask. The structure creates that outcome, not secrecy as a strategy. Invisibility as a natural consequence of how these entities work. The cap table sits there, accurate and documented, inside a folder your attorney holds. It says you own it. That has been true since the day of closing. Year 1, the debt is the dominant fact of the capital structure. You borrowed approximately $3.78 million through the SBA 7A facility. The seller carried back a $420,000 standby note. At close, you injected roughly $420,000 in equity. The business generates $1.5 million in seller's discretionary earnings annually. That is the number the entire structure is built on. If that number holds, the debt service is covered, the working capital reserve is funded, and your equity position grows every single month that principal comes down. Here's what the first 3 years actually look like in a simplified walkthrough. At a 10.5% blended interest rate on the SBA note across a 10-year term, your annual debt service on the primary loan runs approximately $620,000. The seller note is on standby for the first 24 months, meaning no payments flow to the seller during that window. Your operating cash after debt service and a conservative working capital reserve of $80,000 annually leaves a thin buffer. It is not zero, but it is thin. Every dollar of SDE above projection is cushion. Every dollar below is pressure against a covenant. By the end of year 1, the SBA principal balance has dropped from $3.78 million to approximately $3.42 million. That is $360,000 in principal retired. Your equity injection was $420,000. You now control an asset where the debt against it has declined by $360,000 and the business, assuming flat valuation at the same 4 times SDE multiple, is still worth $4.2 million. Your equity value at end of year 1 is approximately $780,000 against an initial injection of $420,000. That is not a profit you can extract. It is a paper position. But the mechanism is real and it compounds end of year 2. Principal balance now approximately $3.4 million. Seller note comes off standby. Payments begin. Combined debt service increases. The working capital discipline that felt optional in year 1 is now the only buffer between coverage and a covenant conversation with your lender. Business value still $4.2 million at flat SDE. Your equity position approaches $1.16 million. You have not sold anything. You have not raised capital. You have made payments on a schedule and kept the business running. End of year 3. Primary balance approaching $2.68 million. Seller note balance reduced. Total equity position approximately $1.5 million on a $420,000 cash injection, assuming SDE held and valuation held. That is the math when it works. It works because leverage amplifies equity accumulation on the downside of debt, not just on the upside of appreciation. The business does not have to grow. It has to hold. That word, hold, is where the uncomfortable part begins. For the math to run the way those numbers show, several things have to remain true simultaneously. SDE cannot compress materially. A 15% decline in SDE does not simply reduce your profit. It erodes your debt service coverage ratio, which is the number your lender monitors every quarter. Most SBA acquisition loans require a DSCR above 1.25. If SDE drops and that ratio falls below covenant, you receive a notice. The notice is the beginning of a conversation you do not want to have. Working capital discipline means you do not fund personal priorities from the operating account, you do not delay payables to manufacture a cash appearance, and you do not let receivables age without active collection. The lender sees your financials. They are not passive. Reporting requirements are quarterly or annual depending on your loan agreement, and those reports create a paper trail of whether you are managing correctly. Then there are the trade-offs you cannot negotiate away. You signed a personal guarantee, the full loan balance. Your personal assets, savings, real property if you own any, are reachable in a default event. That is not a technicality. That is the exposure you accepted at the closing table when you decided the upside was worth it. Restrictive covenants in the loan agreement limit what you can do without lender approval. Taking on additional debt above a threshold. Making distributions above a defined amount. Making capital expenditures that exceed the agreed budget. Selling assets. Hiring a management layer that changes your reported compensation significantly. Each of those is a potential covenant trigger. You are not free to run the company purely on instinct. You are running it inside a contract. The optionality that existed before the acquisition, the ability to change jobs, move cities, take on a different kind of risk, is now constrained. Not permanently, but for the duration of the loan, you are attached to this asset in a way that is legally and financially binding. And you are concentrated. One company, one market, one industry, one set of customers, one revenue line. Everything that was diversified about your financial life before is now stacked behind a single operating entity. Most employee buyouts do not fail at the negotiation stage. They fail in the first 24 months of operation. The most common cause is overpaying on SDE. You accepted the seller's add-backs without scrutinizing each line. The real SDE run rate after you own it without the seller's presence is 20% lower than modeled. The debt service does not adjust. You absorb that difference in full. The second cause is working capital and capex underestimation. The building needs a roof. A key piece of equipment requires replacement. The receivables aging was worse than the QA fee suggested. These are not surprises in retrospect. They were present in the data before closing. The third cause is a culture and authority mismatch. You were a peer or a subordinate inside this organization. Now you control it. Some employees adjust. Some do not. The authority transition is not automatic, and the discomfort is not temporary. The fourth cause is denial about sales and operations reality. The seller was the relationship. The seller was the technical knowledge. The seller was the operational memory. You agreed to a transition period. That period ended. Now you find out what actually transferred. What costs you invisibly is different. You are carrying information that nobody around you has. The stress of hidden control is not psychological drama. It is the daily friction of making significant decisions without being able to surface the full weight of your position to the people around you. There are fewer people you can think out loud with. There is limited ability to signal authority when you need it and suppress it when you don't. The mechanism is debt paydown, converting leverage into equity month by month, payment by payment. It is real. It is documented. It is not guaranteed. Pressure test the STE with an SBA literate CPA before you sign a letter of intent. Build a covenant-aware financial model that shows you what happens to DSCR at 85% of projected SDE, not 100%. Engage a transaction attorney who has closed SBA 7A acquisitions, not one learning the structure on your deal. Decide whether the concentration risk, the personal guarantee, and the 3-year constraint on optionality fit your actual risk tolerance, not your aspirational one. The holding LLC exists. The cap table is accurate. The debt schedule runs whether the business does or not. That is the mechanism. That is where this ends.